Please subscribe to my channel. In this video, I'm going to solve different financial ratios using the most recent data available for Apple. So first of all, I'm going to access the Apple's financial statements. We're going to go to Google and I'm just going to enter Apple Investor Relations. When I go to Apple Investor Relations, I'm going to look at the SEC filings, and I'm going to look at the annual filings, which will be available for 2019. Here you go. I'll open it as a PDF. So here usually we will find financial statements link on the second to third page. Right here, item 8, financial statements. And guys, we will be looking mostly at the balance sheet, but also at the income statement. So this is Apple's balance sheet. You can see there is data for 2 years, ending on September 29th, 2018, and ending on September 28th, 2019. All data, except for the number of shares, is in millions. However, when we calculate ratios, we do not need to worry about zeros as they will be canceled out. So mostly I will be using this data from the balance sheet. And right before it, there is a statement of operations. That's how Apple calls their P&L statement or their income statement. Okay, so here I have with you different ratio analysis areas, and there are 4 areas of ratios, 4 types of ratios. The first group we will look at will be liquidity and efficiency ratios, and they will show the company's ability to meet its short-term obligations. Does the company have enough liquidity, enough cash or near cash items to pay its short-term bills, as well as is the management of the company using their revenues efficiently? So that's the first group. The second group will look at how heavily does the company rely on debt. It's called solvency ratios, the company's ability to generate future revenues and meet its long-term debt obligations. The third group will look at the company's profitability, the ability to provide financial rewards sufficient to attract and retain financing. And the last one will be market prospects, so the company's ability to generate positive market expectations. So as I mentioned, we will have those 4 groups, 1, 2, 3, 4. This is a summary of ratios and their formulas. And the first group will be, as I mentioned previously, the liquidity and efficiency ratios. So we're going to look at these 7 ratios, starting with the current ratio. So here is the formula for the current ratio, which is going to take the assets, current assets for Apple, and we will divide them by current liabilities. So let me just go back to the Apple's balance sheet. I'm going to take current assets. It's actually $162.8 billion. But as I said, zeros are not important. I'm going to take current, not total, current assets, which are assets into cash or use up within 1 year. And we're going to divide them by current liabilities, debts that come due within 1 year. So this is 105,718. So let me just plug in the numbers. I'm going to take 162,819 and divide, those are current assets, and divide them by 105,718, which are current liabilities. And when we divide them, let me use a calculator. So here you go, 162,819 divided by 105,718. Oops. 162,819 divided by 105,718. It's gonna give me, this is wrong, it's supposed to give me 1.54. So 1.54, let me just enter it right here. It means that for every dollar of current debt, bills that come due within a year, the company has $1.54 of current assets. In general, if this ratio is below 1, the situation is not good. If this ratio is above 2, it's a good position, good liquidity position. Between 1 and 2, we are not sure, and we're going to use the second ratio called acid test ratio to measure the company's liquidity further. So in general, we want it to be higher. So for acid test ratio, our denominator remains the same. It's still current liabilities of 105,718. But for let me make it a little bit longer here. But for numerator, we're going to use so-called quick assets. And quick assets are assets, current assets above inventory. Usually these are the three groups. Not every business will have them. It's the cash and cash equivalents plus current or short-term investments plus current receivables. So let me look at what Apple has above inventories. They have those three groups. So I'm going to take these three amounts right here and I'm going to add them up. So we're going to take, again, we're going to take cash, which is, and cash equivalents, which is 48,844, plus marketable securities, which are the short-term securities, 51,713, plus receivables, which is 22,926. These are quick assets. These assets quickly, within up to 90 days, they will become cash. And it's 123,483. 123,483. So this is truly the assets that will become cash. We did not include inventory, so anything below. So I'm just going to divide this by current liabilities of 105,718, and it gives me 1.17, 1.2. So if this ratio is above 1, it means the business has more quick assets than current liabilities, so they have enough liquidity to meet their short-term obligations. So I'm going to just enter here. Again, when we added quick assets together, it was 123,483 million. And when we divided, we got with you 1.2. It's above 1, so it's a good sign. It's a good quick ratio. It's a good acid test, ratio. The next ratio looks at how many times a company converts its receivables into cash every year. So I want this turnover in general to be higher. However, if it gets too high, it means that the company might be losing its customers. So we're going to take net sales from the income statement, or Apple calls it the statement of operations, and we're going to divide it by average accounts receivables. Whenever you see the word average, that means you have to calculate that first. You're going to take beginning accounts receivables plus ending and divide by 2. So beginning AR are ARs from last year. So if I'm going to go to Apple's, my accounts receivables were 23,186 plus current or ending of the period 22,926, and I'm going to divide it by 2. I'm going to do that first. Let me just plug it in. So we're going to take beginning accounts receivables, which is 23,186, that's last year, plus ending accounts receivables, which is the balance for this year, and it's 22,926, and we're going to divide it by 2. So I'm going to get here, when I divide it, 23,056. So $23 billion is the average AR that goes into the denominator. For net sales, we have to go up a couple of statements, and it's usually going to be at the top. So Apple separates it into two categories, products and services. So I'm going to use this total net sales figure of $260 billion. And by the way, we will use this figure of net sales in other ratios too. To 61.74, and when we divide it, we're going to get 11.3. So about 11 times a year the company collects its receivables. The higher, usually the better. And then relating to this, where this formula is pretty much flipped over. We put net sales on the bottom and just the AR, not average, but just the current period's AR to the numerator, to the top. And this ratio is called days sales uncollected. Again, just the ending inventory of AR, so we're going to put it in the numerator, and it's going to be 22,926, and net sales goes to the bottom, and that's going to be 260,174, and we're going to multiply it by 365 days. So we're going to get with you the number of days it takes Apple to collect its receivables, and it's 40 days. So 40 days the sales remain uncollected, or every 40 days we collect our receivables. The lower usually the better. However, there's usually a range. Inventory turnover and relating to it, day sales and inventory. Look at how efficiently management sells its inventory. And again, you can see that we're going to use COGS, cost of goods sold, in the numerator, and average inventory in the denominator. So guys, we again have to use, now let me go back to the balance sheet. So we're going to use inventories, both of them. We're going to add them together and divide by 2. So that will give me the average amount of inventory. So I'm taking inventory from the previous year, which is 4106. 4106. Oops, I'm missing that one. Plus ending inventory, which is inventory for 2019, and it's $3,956 divided by 2. And so my average inventory when I divide it by 2 is going to be 4031. Cost of goods sold is usually, it's reported on the income statement. So most of the companies call it cost of sales. Here it is. Total cost of sales is 161,782. It goes into my numerator, 161,782. And when we divide, I'm going to get inventory turnover, how many times merchandise is sold and replaced during the year. Again, I want a range, but in a general sense, the higher, the better. And it's going to be 40 right here. Oh, in my previous one, I'm sorry guys, right here, it should be 32. I looked at the one, 32 days, not 40 days. And here it's going to be 40 times a year. So Apple sells it very fast, their products, and to no surprise, 40 times a year. And then if I take this formula and I flip it over and just use the current year's inventory, we're going to have the ratio called days sales and inventory. How many days does it take Apple to sell their inventory? So the ending inventory is 4106. Cost of sales or cost of goods sold is 161,782. Let me double check from the previous, 161,782, yes. And we're going to multiply it by 365 days. And we're going to get with you, when I calculate this, we are going to get with you 9.3 days only, right? It takes Apple only 9 days to replace its inventory, to completely sell out their inventory. Very efficient. The last ratio in this category is called total asset turnover. And guys, we're going to use net sales that we already looked at. So net sales we used with you in the accounts receivable. So 260, I'm just going to copy it, 260,174. So I'll put it right here. And in the denominator, we're going to use average total assets, not the current assets. So this is a common mistake where students, by mistake, take the current assets figures. We need to use total assets. So I'm going to take these two amounts right here, 338,516 plus 365,725, and divide by 2. So I'm going to just plug it in right here. So my beginning total assets are 338,516 plus 2019 assets are 365,725, and we divide it by 2. And so let me do it on the calculator. We have 338,516 plus 365,725, and we divide this by 2 to get the average, and I'm going to round up. So my average is 352,121. 352,121. And so guys, let me zero it out. 260,174 divided by 352,121 gives me total asset turnover. I'm going to round it up to 0.74. The higher the better. So every dollar of assets generates 74 cents in sale. And again, you can look here at Apple's competitors. Whoever has the higher asset turnover is more efficient in using assets. The reason the companies buy assets is to generate more sales and eventually more profit, more net income. And also you can find industry averages and compare how Apple is doing compared to the industry. Or you can also calculate this factor for previous years and see what the trend is. Is it going higher or is it going lower? We want this ratio to be higher. The next group of ratios are called solvency. It's called solvency ratios, and there is 3 of them. It looks at the company's reliance on debt. And guys, debt and equity ratios together give me 100%. So if I know debt ratio, then if my debt ratio is 40%, then my equity ratio is 60%. Together, they have to add up to 100% or to 1. For debt ratio, you take total liabilities over total assets. For equity ratios, you take stockholders' equity over total assets. So the debt ratio shows to you how much of the company's assets are financed with debt. I want it to be low. My equity ratio shows how much of the company's assets financed with the stockholders' investments, and I want this one to be high. So I'm just going to calculate debt ratio, and for equity ratios, I'm just going to subtract that from 100%. So for debt ratio, let me look up total liabilities, not the current, but total, right here, 248,028, 248,028. And I'm going to divide it by total assets right here, 338,516, 338. And even before I calculate it, you can see that debt is a major factor for Apple, unfortunately. And it's, it's a negative for this business. One of the negative features of Apple's business is that they finance a large portion of their assets with debt instead of equity. Even though financing it with debt has certain advantages, especially to current stockholders, in general, we want companies not to rely as heavily. You can see 73%, right? 73%. Another way to think about it, for every dollar, if you look at a dollar of assets, 73 cents of it are financed with debt, which means only 27 cents, right? So if I go 100% minus 73%, then we will see that it's 27% only is financed with equity, or 27 cents on the dollar. Not very good. And then the last one looks at both of total liabilities and total equity and divides them to each other. So the title of the ratio, debt to equity, we take total liabilities, total debt, and divide it by total equity. So I'm just going to copy, let me go right here. I'm going to copy total liabilities, 248,028, put it right here. And then for total equity, let me look it up. So here is total shareholders' equity is 90,488,000,000. And when I divide them, I'm going to get 2.74. So what does it mean? I want this ratio to be low. If it's below 1, it's good. We have less debt than equity. If it's above 1, not good. We're way above 1. So for every dollar of equity, the company has $2.74 of debt, of liability. Very high portion of liability. All right, I hope it makes sense. And then we have the next third group, profitability ratios. So for profitability ratios, the first one is net profit margin. We're going to use the income statement. It shows the company's ability to earn net income from each sales dollar. So we're going to go to the statement of operations, and we're going to take the net income on the bottom right here, 55 to 56, double underlined, and divide it into net sales. So the bottom line into the top line. And this is a very useful ratio that is easy to understand. So again, we're going to take 55 to 56. This is the bottom line. This is the profit. This is net income, $55.3 billion. And we're going to divide it by net sales of 260, 174. So for every dollar of sales, let me go right here. It will show me how much Apple keeps in profit. So if you spend, $100 at Apple Store, how much of that $100 will be Apple's profit? And here is the answer. It's gonna be $21. So 21%, I'm not going to round up, which is a very nice profit margin, 21%, very nice. So from every dollar they keep 21 cents, which means 79 cents are their cost of goods sold as well as their operating expenses. The next one goes hand in hand, and it's called gross profit margin. And this ratio shows the amount remaining from $1 in sales that is left to cover operating expenses and a profit after considering cost of goods sold or cost of sales. So we're going to take gross profit, which Apple nicely reports right here. It's gross margin, same thing. Some companies don't report it, so you simply take net sales minus cost of goods sold or cost of sales. So 98,392, and we're going to divide it by the same net sales that we used in the previous ratio, and it was 260 divided by 174. When you use your calculator, you will get 38%. So what it means is that for every dollar of sales, the company spends 62 cents on cost of sales, has 38 cents left. And looking at the previous, out of that 38 cents, 21 cents are kept in profit. So 38 minus 21 gives me 17 cents are spent on operating expenses. And guys, I put it as a pie chart right here, so you can see 21% is my, this is the net income, net profit margin. And guys, together 21 and 17, this is gross profit margin, so 38 cents. So gross profit minus net income gives me how much on a dollar the company spends on operating expenses. Not very much. This is actually really good. And you can see the difference. So dollar minus gross profit gives me how much on a dollar they spent as their cost of sale or cost of goods sold. Very useful. Managers love this kind of visual representation. The next ratio is called return on total assets, or it's better known as ROI, return on investment. I as an investor want to know how much profit does the company earn for every dollar of assets. So average total assets we used with you before. Average total assets, we've used it, let me see, in the previous ratio right here. Oops. Average total assets were already calculated, so I'm going to copy this. And guys, that goes into the numerator. And in the denominator, right here. And in the numerator, we're going to place net income that we've used before. When I use net profit margin, this 55 to 56 is net income. And it's a great ratio, right? So if I kept my money in the checking account, I would make 0.01% a return on investment. If I look at Apple and I give them my money and I buy shares of stock and they use my money, how much do they return on my investment? They return, when we divide here, It's 16%. Excellent. A very high ROI. Very high. Guys, the last ratio here is called basic EPS, earnings per share, and we are not going to calculate this was earned for every share of common stock outstanding, and this is the most frequently used or quoted piece of financial data. So this ratio actually is the only ratio that companies report on their financial statements. Here it is. So the every share of common stock back in 2019 made $11.97 in net profit. So it's reported right here on the income statement of operations. And guys, the very last group of ratios look at market prospects. We're not going to calculate them. One is called PE ratio, and this last one is called the dividend yield. And guys, we're just going to look them up. So PE ratio takes the company's market price per share, common share, and divided by EPS that we talked about before. So it looks at the relationship between how much value does market give to a share of common stock versus how much in reality earnings, how much profit did that share make. So PE ratio shows me how much the stock is overvalued by the market. And I'm just going to go to Yahoo Finance, and I'm just going to look it up. I'm going to go to quote lookup, and it's APPL. You don't have to know the abbreviation. You can just say Apple. And hopefully it's going to take us to, there it is, to Apple. And I'm going to look at their stock quote. Takes a little while here. And guys, P ratio is right here, 36.11. So that actually is not that bad. I mean, the market price of one share, and if you don't know, Apple just went through a split, I think 7-1 or something like that, 8-1. So their market price went down 7 times because of the split. That their market price is just 36 times overvalued. I mean, usually if it's around 20, it's not bad. I mean, if it's above 100, it's highly overvalued. And the second ratio is dividend yield, and the last ratio, second here in this group, and the last we're going to talk about. And we take annual cash dividends per share of common stock, and we divide it by the market price per share. And it just, the higher percentage, the higher dividend yield it gives to its stockholders. And so, guys, when we are looking at the dividend yield, it's right here, only 0.69%, not very high. So I hope you found this information useful. I went over the commonly used ratios. In reality, there are many other ratios, but it gives you a general picture of how investors and lenders and other external parties look at public corporations and analyze their financial health. Thank you so much.